Welcome back. Thanks for sticking around. Those of you that are here for both days, I see a lot of faces from yesterday. That's good. This is certainly a conference where you want to be here both days, since you've got completely different groups of speakers and completely different groups of companies presenting. I'm just going to go through, where I think things are at right now. I think I want to talk a little bit about precious metals, a little bit about base metals, and how markets are reacting to things, and what I think is going to happen in the next few months. And essentially, the title page you see there sums up really what I think is going on out there right now. You've got this dichotomy between what consumers, general population surveys, confidence surveys, those all send one message. You look at hard data, actual retail sales, car sales, bank loans, you name it. The message so far, at least this year, has been quite different. There's never really been as big a divergence between opinion surveys and hard survey data when it comes to economic readings. Nobody's really that sure why this is. Nobody's either sure about which way this divergence is going to disappear, because it will. I mean, these divergences generally don't last. The question is the actual data, retail sales, that sort of thing, is that going to come up to meet the very high confidence levels that you're seeing across the board in surveys, or is the confidence level going to start to dissipate because the hard numbers aren't coming up? I'm of the opinion that it's probably going to be the latter. I'd be quite happy to be wrong about that. I hope I am, actually, but so far I'm just not seeing acceleration, and that's what I'll deal with a little bit first. And but the first thing I want to deal with there, it's kind of hard to read this. That's a screenshot of someone selling tickets to Myth on Craigslist, and just out of curiosity, come on now, fess up. Did anybody buy their Myth ticket? Come on, you can tell us. What did you pay, Mike? I love that girl. Good girl, Emma. I didn't actually think to check if it was my daughter's Craigslist entry. Okay. Well, I just wanted to say to any of you out there that paid for your Myth tickets, God bless you, and I'm going to give you free drinks at the end of the day. So, good. Okay, you're in. Give that guy a free drink at the end of the day. Now, as I just mentioned, I mean, we were seeing this huge divergence. I mean, at the end, what it comes down to is everybody says things are going great. Everybody says they're in a great mood. But when you look at the actual sales, actual retail sales, actual car sales, credit expansion, like pretty much everything, they're not acting the way that they're talking. It's quite strange. And this divergence is really what's driving a lot of things lately. Right now the meme in New York and in most financial centers is that Q1, for whatever reason, pick a year, Q1, it's just sort of this new thing where Q1 is always weak. It's always by far the weakest of the four quarters. Nobody's sure whether there's some, they've blamed weather a couple times. Other people say it's some sort of psychological thing. The most likely argument, if this is true, is that there's simply some kind of sampling problem. Like something is being done wrong that's basically screwing up the Q1 sampling. But if you look at this chart, this shows you there's something called the Atlanta Fed GDP Now, which I keep a pretty close eye on, because they basically track what they think the current quarter's GDP growth is going to be based on inputs, and they change it all the time. So every time there's an input that could impact the GDP reading, they'll recalculate it. And this shows you what it's done the last 4 years as you go through Q1. And every year it's dropped like a stone, and it seems to have gotten worse over the last 4 years. The one on the extreme right is this year's reading, which was particularly bad. It started out at about 3.5%. It ended up at 0.2. The actual reading for Q1 ended up being 0.7% growth. Now, weirdly, this has become such a thing, it's such a meme that everybody thinks this is some kind of a one-off weird thing that you can sort of almost ignore. Ever since then, ever since we flipped over into the current quarter, the assumption is we're gonna go back to 3.5–4% growth. One of the reasons I think you saw, actually, one of the big drops you saw this week in the gold price was actually the Atlanta Fed starting off their current version of the GDP Now calculation at a very high number, which is, they started out at 4%. That seemed to really freak people out, and they were like, okay, well, it's back on, we're gonna see all these Fed rate increases. You know, as I said, this is a calculation that changes every time data comes out. I wouldn't read much at all into where they started, because they almost always start at higher than the consensus economic forecast, because they don't really care. That's just a counter. Like, it's going to change every time new data comes out. It's the one. It's what it looks like towards the end of the quarter that matters, not what they set it at the start. That's just a plug number, basically. But for whatever reason, everyone's decided you're going to get this huge acceleration. The Q1 was just a blip. Maybe it was. You're seeing the impact of that assumption that things are going to accelerate quickly, plus the assumption that we're simply, you know, some of the stuff people were worried about, like the French election, the lack of legislative action in the US, some of that is being fixed. And you've seen a really strong shift in the last 2 or 3 weeks from sort of neutral markets to very risk-on markets. And you see the impact of that in both the gold price and the US dollar on these charts. I mean, the big drop you see in the US dollar on the left side, that was the French vote, the first round voting in France. The euro had a huge, massive move off of that. The dollar dropped, but you didn't see the gold price increase. A lot of people that assume gold always trades against the US dollar were probably a bit dazed and confused and unhappy about this. But as I tell readers, that correlation, there is a correlation, but it's not, you know, it's not always a negative correlation between the US dollar and gold. It shifts all the time. As it happens right now, the correlation is positive. They're moving together. Both the US dollar and gold have been dropping. I expect the polarity to shift again as things change over the next few weeks. But right now, this is just a pure risk-on market. Gold, for a lot of traders, is considered a risk-off trade. So they're basically just selling gold because they're buying everything else hand over fist. Now, ironically, what you've seen at the same time as this, you know, when I talk about how there's sort of hard indicators and soft indicators, one thing that some people would certainly read as being a hard indicator is the oil price. Oil's gotten killed even more than gold, significantly more. The oil price has been getting creamed for the last 3 or 4 weeks. That didn't surprise me too much, because I've never been someone that was a big believer in the OPEC agreements. I've seen them come and go so many times in the last 20 or 30 years. I don't take them that seriously. I didn't expect the oil price to stay up. But one thing that the falling oil price has been doing is that's been reducing inflation expectations, because oil is one of the main drivers of general price increases. And if you look at the left chart on this slide, that's basically the break-even inflation expectations based on the TIPS yield, the 5-year and the 2-year. Those are inflation-protected bonds. This is used as a proxy for what people think inflation is going to be going forward. You can see it topped out about a month and a half ago. It's come back from almost the mid-2s. It's back down to about 1.8. That has a couple of different impacts. That's happening, you know, even though we're seeing that, because we're back into this, we're going to have 4% growth meme, traders have upped their expectation. The chart on the right, that shows you the expectation, the odds, if you will, for 3 rate increases or more this year. You know, it got down to the 30% range. It's jumped back up above the 50% range. That's basically telling you bond traders in particular think it's more likely that we're going to see the Fed actually stick to their 3 rate increases, or maybe even do more than them. That's based on the optimism that's come into the market in the last 2 or 3 weeks. That combination of reduced inflation expectations, higher optimism and expectations for Fed rate increases, that essentially drives up real interest rates, real inflation-adjusted rates. Real inflation-adjusted rates and gold prices definitely very much do have a strong negative correlation. And part of the reason why you've seen this fall off in the last couple of weeks is that essentially real interest rates in the current market have gone up from being slightly negative to being slightly positive, and that's also generated a lot of selling in the gold market. I don't think that's necessarily a long-term thing, but I think that's explaining what's going on right now, which is all I'm really trying to do. As if all that wasn't enough, this chart's a little bit hard to read because there's kind of small data points, but look at the extreme right side of that chart. The amount of selling that's come out of the GLD ETF in the last couple of weeks is just unbelievable. There's a lot of reasons for this. It's way too long for me to go into. I'd need my whole talk and then some. But essentially, there's going to be, the GLD ETF is extremely popular, and what the ETF does, as it's being bought and sold by traders, the float of the GLD ETF decreases or increases all the time. The people running that ETF, in turn, buy gold stocks, juniors and seniors, in a predetermined percentage, a predetermined makeup for the ETF, and they're rebalancing every day. They're basically trying to match the ETF to this index of gold stocks. So that this ETF, it's become extremely large. There's a lot of buying and selling in the market. It's actually gotten too big for its britches, quite frankly. They've got a problem where the combined market cap of the companies that they're using in the index is simply not big enough to handle the amount of volume, buying volume that they're getting of the ETF. So there's going to be a big rebalancing next month. They're going to add a bunch of larger companies, which kind of defeats the purpose a little bit. It's not going to be a GDXJ so much anymore. But the knowledge that that's happening, plus the perception among traders of how they're going to rebalance the constituents of it. So, company A is going to go from being 5% of the ETF to being 2% of the ETF. In the case, because of how big this thing is, that implies a lot of selling once that rebalancing is done. Of course, traders being traders, they're front-running this. That's what traders do. You try to get ahead of this stuff. Personally, I suspect when we come to June 17th, which is when the rebalancing happens, I suspect the impact then is going to be fairly minor because everybody's front-running it so hard right now. But this is just another thing that's generated a lot of selling in the last couple of weeks. It's unrelated to the other things really, but it's added more fuel to the fire and freaked people out a little bit more. On the base metal side, it's all about China, and it probably should all be about China. We have seen some of the base metals come off in part because some of the Trump reflation trade is unwound. I never really understood the Trump reflation trade when it came to base metals anyway. The US is not the world's big marginal demand for base metals. It hasn't been for about 50 years. China's the 800-pound gorilla, no two ways about it. That's the area you got to watch if you're watching for base metal or materials demand. And there has been some drop-off in their ISM surveys. A lot of people that keep proxies of, they're third-party private groups that keep proxies of things like electricity consumption, things like that, to try to gauge how the Chinese economy is doing, because nobody really quite trusts the real numbers, the official numbers that come out of Beijing. But there's definitely been a downturn. If you look on the chart on the right side, the official numbers, kind of the light blue line, the third-party private activity tracker, you can see there was this huge divergence going through 2013, 2014. In the last year, the private tracker came back up to where the official numbers were. In other words, they agreed that, yeah, it does look like things have picked up. We're back up to 5, 6, 6.5% growth. But you can see just in the last little while, those private activity trackers have been dropping off again. And that's got people freaked out. That's been generating, in my opinion, some of the selling on the materials and the base metal side. That's probably most evident in the iron ore market, which has made no sense to me for the last few years anyway. I thought it was insane that people were bidding up iron ore prices as high as they were. There's no shortage of iron ore around, believe me. There's plenty of it, and there's plenty more where that came from. But it was a measure of, one, confidence in the Chinese economy, and two, Chinese investors themselves, again, front-running this. Copper is the same way. You've seen copper, I'm not that worried about copper, you've seen it give up a bunch of the post-Trump gains, if you will, the post-US election gains, but if you look at the extreme left side of that chart, you see that big run-up from about 220 to 260, 270. That buying all came out of China. That was Shanghai traders. Those guys still seem to be around. They don't seem to be as concerned about a drop-off in copper demand as Western traders do. And again, like I said, China's the 800-pound gorilla. I don't expect copper to do fabulously well, but I'm not that worried about it. I'm not worried enough that I'd be staying away from copper deals, that's for sure. The one that's acted the best, I guess, and this won't be a secret to anybody that gets my newsletter, the one that I've spent a lot of time on is zinc. For me, zinc has also had the same pullback when everything else was seeing the selling recently. Zinc saw it right along with it, but you'll notice towards the right side of the left chart there was a bottom put in about a week ago, and it's kind of climbed its way back up to about the $1.20 level. Perhaps the most important chart for zinc is actually the one on the right side that shows warehouse inventory levels, and they just keep declining and declining and declining, and they're getting down to historically extremely low levels. Recent comments by Glencore, which is the biggest potential outside source of supply, are they going to restart this 500,000 tons a year of zinc output that they shut down about 18 months ago? Based on their most recent quarterlies, this was only a couple of days ago, comments by their management, they're saying, no, we're not going to do that. Like we told you guys 18 months ago, we're not going to screw the market up when we decide to flip the switch, and we're still not planning to screw the market up. So no, if you're expecting this to happen right away, it's not going to. That being the case, I'm not too worried about zinc prices. I expect we're going to see another run before year end, which shouldn't surprise you when you see who's sitting on the table next to me, or guys I invited. So now what? Big picture comments. There's no doubt there's been damage done to the gold market. It's going to take some time for that to resolve itself. The common opinion, I guess, I'm notwithstanding that I can just throw a bunch of charts at you. I'm not a chart guy. I mean, I just use them as talking points. So I'm not a TA guy, so I can't really help you out there. Guys like Jordan, who I mentioned earlier today, has been right to give him his due. The price did do what Jordan said it would do. They seem to generally have the opinion that we're looking at a few more months before it bottoms out. He may well be right, which means fall rally. I'm not 100% sold on that, simply because I'm not 100% sold on this whole, Q1 was just a blip and we're just going to go back to 4% growth in Europe and the States. I won't believe that until I see the hard numbers to back it up, and so far I haven't. I mean, the most recent numbers on things like retail sales, car sales, stuff for April basically, they don't look any better. So far this huge acceleration is supposed to happen. And even the jobs or the payrolls report, which was another smackdown for gold yesterday. Yeah, it was a good payrolls report. The U.S. won 211,000 jobs, but the number that I always harp on and that I bring up every month when I look at these things, it's not so much the payroll gains I always look at, it's the wage gains, the hourly wage gains. Not for the 1%, for the other 99% that actually drive the economy. Again, lousy wage gain. The year-over-year wage increases are actually falling, not rising. I have a bit of trouble wrapping my head how you make that and a labor market that's supposed to be incredibly tight with a 4.5% unemployment rate makes sense. But there it is. The wage gains aren't accelerating, and I think until that happens, I don't see how the U.S. economy accelerates that fast. Conversely, Europe's actually doing fairly well. I mean, I don't think there's much of a divergence anymore between U.S. and European growth. They're about the same level. For base metals, obviously the 800-pound gorilla, it's China, it's not the States. We have to see whether this drop we've seen in the last little while actually gets maintained. But again, you still need to look at individual metals on the base metal side and what does their supply-demand balance look like. I think the supply-demand balance looks great for zinc, so I still think zinc's going to have a good year, even if China slows down a little bit. I don't think it's going to have that much impact. There'll be short-term periods where there's sell-downs because traders react to this stuff, but the real-world pricing I think is going to be fine. I don't expect copper to have a fabulous run, but I don't think it's going to do that badly, and again, not badly enough that I would stay away from copper deals. There's way too many words on this slide, but I'm going to try to run through it super fast because I'm almost out of time. Basically, relative yield in gold prices for a while, but I still think there's definitely potential that the turn comes sooner than a lot of chart guys think. If Q2 ends up being not much of an improvement over Q1, which is my expectation, but I like to stick to hard data, so I'm not going to second guess it. I'll just see how the numbers look as they come in. I don't expect, that being the case, I don't expect really big drops from here. The important point to take away here is we're in a resource bull market. Don't get yourself freaked out by the fact that we're in the midst of a pullback right now. I think companies that can deliver good news, be that companies, and there's basically two types of stories I follow, and they're represented at this table. I mean, one is early stage stories that have the potential to deliver major re-rating based on discovery. The market doesn't care whether the gold price is up or down or the copper price is up or down the day somebody puts out a great drill hole. The market couldn't give a crap because the market's trading that story. So, and yes, if everything's in this massive uptrend, is it better? Sure. But is it going to make a significant difference on discovery stories? Not really. So that's why I continue to look for discovery stories, because they'll do better in a really strong uptrend, but they'll do well even in a kind of a blah market. If they make discoveries, they get re-rated. The other end of the spectrum, you know, strong development stories where they're either, you know, doing one of two things, preferably both: growing resources, improving the economics of the project. Because one thing that definitely hasn't changed, and what, you know, however long this little correction we're in right now lasts, it won't have any impact on the other major trend that underlies this whole bull market, and that's that the problem that majors have, that they simply don't have enough good projects in the pipeline, has not gone away. It's not going to go away anytime soon. You know, all of these guys can work their ass off for the next 5 years. The majors are still going to have a problem with strong projects in the pipeline. So companies that can build value, show that they've strengthened their resource, show that they've got something that either because of location, grade, other input costs, comes in as one of the, say, lower quartile cost projects, something that's developable, those things keep getting taken out, and that's the other kind of story that I'm following. So that basically tells you the two type of companies I'm still comfortable with. Yeah, the market might be weak for a couple months. You probably don't need to chase things, but I also wouldn't be, you know, I wouldn't be throwing away the screen and saying I'm going to come back in September. I think there's going to be good stories out there through the summer, and I think if somebody's got a strong discovery, it won't matter if it's a summer doldrums. I mean, if somebody pulls a big one, it's still, and in fact, sometimes they even get more attention this summer because so many guys decide not to put out news in the summer that the one guy that has something he has to because it's material gets that much more attention because it's not a crowded field. So with that said, that's basically my little spiel. I'm going to introduce Mike Williams.